I'm Julie Barkey with Senate Update. A budget surplus of nearly $2 billion has lawmakers working on bills that would spend some of the money, some would save it, and others would provide tax relief. Well, several proposals in Tuesday's tax committee would reduce the estate tax. Senator Carla Nelson's bill resulted in roughly an hour of testimony.
The bill I bring before you today is very similar to Senator Franzen's, which bill you just heard. However, Senate File 743 jumps that exclusion to conform to the feds, and it also strikes the Minnesota-specific estate tax filing requirement and requires that a Minnesota return must be filed if a federal return is filed. So it actually conforms to the federal tax subtraction for purposes of calculating the Minnesota taxable estate. The federal exclusion amount is $5 million annually adjusted for inflation, and so for this 2015 the amount of course is $5.43 million, and this bill would conform to that. And I think that's the long and short of that bill. Mr. Chair, would you like me to introduce my testifier?
I think we'll let Senator Coonan speak, and then we'll bring the testifiers up. Senator Coonan.
All right. Thank you, Mr. Chairman. And this bill is the same as Senator Nelson's. It does the things she talked about. It fully conforms to the federal estate tax exclusion, which is now $5.43 million for tax year 2015. It repeals the qualified small business and farm property exclusion that's in current law, because if this were to go into law, that wouldn't be necessary anymore. And it adopts the federal portability rule that allows a surviving spouse to use unused portions of their spouse's exclusion, and requires that a Minnesota estate tax return be filed only if a federal estate tax return is needed, and the bill adds inflation to the exclusion amount each year. And if you look at on page 4 of the bill, starting with line 4.11, you'll see the tax rate amounts there, and it's well, first of all, I should add that the way this is calculated is that it takes the federal exclusion and just eliminates that from the possible Minnesota amount that is taxable. So then, which would be the $5.43 million. So after that amount, it starts with the amounts above that, and up to $7.1 million is taxed at 13%. And then if you go down there to line 4.15, you'll see, and through line 4.21, you'll see the breakout amounts and the percent tax on those amounts. So for example, on line 4.15, it would be over 7.1 million, but not over 8.1 million is 13.6%. And the 923,000 you see there is the 13% on the amount not over 7,100. So it just keeps building as it moves up as it's calculated.
Senator Coonan, so am I understanding that right? That would be an automatic adjustment mechanism that would keep it in place in line with what the federal exclusion is? Is that what I heard you say?
Yes. Maybe Ms. Pollack can comment too, but it's my understanding when I read this that this exclusion amount adjusts along with the federal exclusion as that goes up with inflation.
Okay, Ms. Pollack.
Mr. Chair and members, yes, that's correct.
Thank you. Any questions of the authors, members? And I don't know if you have an opinion, but maybe you guys would want to join us at the table, and we'd leave the testifier table for testifiers, and you can just be part of the discussion. Yes. Is that okay?
Yep, Mr. Chairman, that sounds good.
No questions from members. Let's move to the testifiers. Miss or Mr. Allen? Mr. Brommelkamp and Ms. Kadoon.
Mr. Chairman, did you say these bills are
Senator-
exactly alike?
Senator S., yes, they're the
Exactly.
same bills.
Okay.
Well, let's start at the top. Ms. Allen.
Chairman Sco, Senator Nelson, members of the committee, thank you for the opportunity to provide testimony in support of Senate File 743. I'm Dr. Dana Allen Tully, a partner in Garland Dairy Farms with my parents and brother at Eota, Minnesota. Garland Dairy started with 40 cows when my parents bought the farm from my grandparents in 1976. Since then, our farm has expanded to include my brother and myself with the help of 43 full-time employees. We are the second largest employer in the Eota area behind our school system. Senate File 743 is about ensuring a healthy, sustainable agriculture sector for generations in Minnesota, for future generations in Minnesota. Today, land prices are $8,000 to $10,000 an acre. Dairy cattle are $1,900 a head. A planter is $10,000 per row, and a new tractor is anywhere from $130,000 to $250,000. The additional burden of estate taxes could very likely deplete our working capital and ability to operate at the untimely death of my parents. This may have an unintended consequence of putting our 43 dedicated employees out of work as well. The random nature of death requires us to manage my parents' estate to make sure the business succeeds for future generations. This imposes significant transactional costs annually for us to hire accountants, lawyers, estate planners, and appraisers. These are resources that could be spent on growing and improving our business. But without this focus, my brother and I will not continue to operate our business after our parents pass. For the last 20 years, my parents have been working with consultants to ensure the farm they worked hard to grow continues to be successful after we have lost them. I urge you to provide certainty to Minnesota's farmers and future generations by supporting Senate File 743. Thank you for your attention.
And Ms. Allen, as a farm, you would qualify for the current small business and farm exclusion that's $5 million an individual. And this proposal does raise that somewhat.
Yes, allows it to increase on inflationary rate. But it also provides us certainty so that as we plan in years coming forward, that we know.
Okay.
Mr.
thank
Chair,
you. Senator Gazalka.
I'm thinking if this bill adds portability and both parents are alive, it's 10 million.
Yeah, and I don't think this bill, does this bill have portability? It does, yes. This bill does have portability, so it's 10 million then, yes. Okay.
Mr. Chair.
Senator Nelson.
I would just like to welcome Ms. Allen to our committee. She's the partner in Garland Dairy Farms, which I think I've mentioned before in this committee, but it was designated Minnesota's 2010 Milk Producer of the Year because of their proven commitment to the dairy industry, managing their farm for future generations, and being active in their local community. Garland Dairy is a unique partnership between two very dedicated families in the Eota area. And I'm just very thrilled that Dana was able to make the time to come up here today. It's a big operation that they operate, and I'm very thrilled that she's able to come and provide the testimony today about why it's necessary that these estate plans have more than a 1-year shelf life. Estate plans don't have 1-year shelf lives, but as we continue to change our laws, then those estate plans need to change on an annual basis, which is why I'm so supportive of why I've authored the bill, which jumps immediately to federal conformity. And my hope is with the budget surplus that this is I know that this committee has moved in that direction and has wanted to move in that full conformity direction, and it has it on a phased-in basis now. My hope is that in light of the nearly $2 billion budget surplus that we can jump to this full conformity now and provide that certainty that our producers need. Thank you.
Senator Nelson, you did mention that we have been making progress on moving toward what the request is today, and hopefully we're able to make progress, whether it's incremental or all the way, we'll find out.
Thank you.
Anything else, members, for Ms. Allen? Mr. Brommelkamp.
Thank you, Chairman Sco and members of the committee. Good morning. My name is Mike Brummelkamp. I'm a principal with Olson Thielen, a mid-sized Twin Cities certified public accounting firm. However, I hope I speak for all the practitioners that were asked to testify and weren't able to come because they're busy doing tax compliance work right now. My firm works with many small and medium-sized privately owned, family-owned companies and their owners. My firm provides a wide range of services, including planning and compliance services in the areas of the income tax, the state tax, and the gift tax, as well as business valuation. I'm a longtime member and volunteer with the Minnesota Chamber of Commerce and with the Minnesota Society of Certified Public Accountants. My comments will be brief. Maybe Ann would appreciate that. I speak in enthusiastic support of federal conformity, in particular in the areas of the estate tax thresholds and in portability. The federal threshold was raised to $5 million in 2012 and is now indexed to inflation. As a practitioner, I can tell you that this threshold difference frustrates not only those of us who are CPA practitioners, but the Minnesota residents that you represent who come to us for guidance and counsel. Only 5 states have a threshold less than $2 million. The difference alone is a tremendous learning challenge for us, for our clients to understand what's going on. In many cases, the costs of compliance can exceed the ultimate tax to be paid by particularly the smaller states. And these changes are needed to the Minnesota threshold to facilitate transfers of family businesses, like Garland, and make our state more competitive and able to retain and attract the entrepreneurs and retain our retirees. Policies really should create incentives not to relocate upon retirement or to invest outside of Minnesota. In particular, we're concerned about the baby boom mountain that's in front of us, where there's going to be a large number of individuals that are going to be able to transfer their businesses in the coming years here, and the incentives in place right now because of the differences in the exemptions causes them to look at residency choices as they approach retirement. So with that, I'll conclude my comments and certainly stand ready for any questions.
Questions, members? Senator St. Jim.
Thank you, Mr. Chair. And Mr. Bornkamp, you know, we don't have to walk very far down our local streets before we hear about somebody talking about this issue and the change of residency. Few of us ever sit in an accounting office and have an opportunity to, you know, listen to that kind of conversation. But how real is this change of residency issue from a perspective of an accountant?
Mr. Brommelkamp.
Thank you, Chair. Members of the committee. From a business standpoint, I can speak only for the practitioners that are in my firm, and I've got 20 principals in our firm, so we think we represent a pretty good brush. I can tell you that I deal with it on a weekly basis. I'm enthusiastic as an individual that I appreciate the quality of life we have here in Minnesota, and I want to be here, and I promise you that I will be here. But it becomes increasingly difficult for me to convince clients when they look at the numbers that they shouldn't be considering relocation. I have had that discussion yesterday with a client. I just got back from out of town trip, and they wanted to talk to me, and they're trying to consider what, we are filing their 1040 this year, and they looked at the bottom line and they said, well, what do we have to do with our estate plan, and so on and so forth. And it just gets increasingly difficult to convince somebody that they shouldn't be considering relocation. And obviously, there are a lot of other things that go into these decisions. These are not dollars and cents decisions all the time. But it becomes increasingly difficult for me and the other thousands of CPA practitioners in the state to convince our clients that they shouldn't be considering it. And it is very real, specifically to your question.
Thanks. Anything else, members?
Mr. Chair?
Senator Nelson.
Well, while I don't sit in a CPA office to see this growing concern, I can tell you that I do something that many of us do in this body, which is every year we take that list of registered voters and we door knock our districts. And it was amazing to me each year. I would come upon more and more people who I knew quite well, knew they'd been on the list of registered voters the year prior, and then I would say something like, oh, well, there must be some mistake here. I see you're not listed on the list of registered voters anymore. And they would look kind of sheepishly and then say, well, you know, we have moved our domicile to somewhere else, and we're still here in Rochester for part of the year, but now we're just domiciling where our, you know, condo was for the summer. And eventually it got to where I didn't ask that question anymore, because so many residents that were paying taxes in our great state are now domiciling in other states. And it's something that I think we as elected officials who do door knock and visit our constituents, the incidence of that is growing and it's significant. And so just to add further testimony to the growth in people choosing to not spend their latter years in Minnesota because of our estate tax.
And, you know, I think we'll get the department to come with some data, because I think if we look at the number of taxpayers in the fourth tier and the returns that came in the last year, the numbers don't show a real large exodus. Now, there will be examples, of course, where people are moving, because people move all the time. And, you know, so we'll get the department to see what the tax incident study and what the other studies show with regard to that movement. I don't think we're going to see quite as large of impact as, you know, as you might see, but we'll get some data so we have that in front of us, besides just, you know, individuals' examples. Senator Gazelka.
Yeah, and to that point, Mr. Chair, I think part of it is it takes a while to, if you're going to make a transition out, to sell your place, to make sure you're getting the right price, you know, so we may see it over time. But I'm hoping that the testifier will stay. I see he's not on the testifying for the estate gift tax bills, but I'd like to have you stick around in case we have some questions related to those as well.
Oh, the rest provision. Okay. Well, if you wouldn't mind, sir.
Certainly.
Senator Thompson.
I'll pass, Mr. Chair. I essentially going to make the point that Senator Gazelka made.
Oh,
thank you.
great, thank you. Ms. Kadoun.
Mr. Chair, members of the committee, my name is Beth Kadoun. I represent the Minnesota Chamber of Commerce. I thank so much the authors that brought these bills forward on federal conformity on the estate tax threshold. We think these are very important changes, as the previous testifiers have mentioned. We've been hearing Minnesota's been becoming more and more of a tax outlier in this area. Minnesota is one of 14 states that still have an estate tax. As was mentioned, other states are increasing to that federal estate tax threshold. Most recently, Maryland and New York. New York under Governor Cuomo made that change last year to move to the federal estate tax threshold. So as mentioned, as Minnesota does not make this change, we're becoming more and more of a tax outlier. And we're hearing, as we go around the state, meeting with our business members, we're hearing from many CPAs, financial planners, attorneys all across Minnesota on the big uptick, frankly, in their businesses and conversations they're having with their clients on this issue. And what seems to be happening is when they're looking, as a lot of people are hitting these retirement ages, as they're looking at the future, the estate tax really seems to be that tipping point for many taxpayers on making that difficult decision. A lot of times, to then end up relocating out of state. So we think this is very real. I think when you look at the data, because it does not necessarily impact a lot of taxpayers, and Senator Gazelka mentioned, a lot of times these take years, I think, before data is probably going to catch up with this. So I don't think you're necessarily going to see it in data immediately. Those 2013 tax increases, for example, were retroactive, so you don't really necessarily see any impact in 2013 on any of those tax changes that occurred. But we think this is real, and we're hearing, as I said, greatly around the state. I'll mention just some issues regarding or support for other bills that was mentioned. Portability, we think, will be a great change. The more we can align with the federal on these tax requirements, the better for Minnesota. As mentioned, it's very costly for individuals to plan for the estate tax purposes. So if you can align more with the federal, the better for our residents in the state. And so we have very strong support, and thank you so much for bringing these bills forward.
Thank you, Ms. Kadoun. Questions, members? Thank you. And Mr. Brommelkamp, if you'd be willing to stick around, there might be some questions for you as we move forward here today. Mr. Peterson and Mr. Hickey.
Nelson.
Oh, Mr. Nelson and Mr. Hickey, I'm sorry. All those Scandinavian names. Welcome, Mr. Hickey.
Well, thanks, Mr. Chairman. Mike Hickey with the National Federation of Independent Business, Minnesota, and a lot of you are familiar with our group. We have 13,000 small businesses and farmers across the state, and I think we're likely the most affected group when it comes to this tax. Virtually all our members are privately held, and many of them struggle with this issue as they try to pass on a tradition in commerce or farming to family members. Appreciate you holding a State Tax Tuesday here, Mr. Chairman. A lot of great ideas. We feel very optimistic that some good things are going to happen this year, and appreciate your interest in this issue. We strongly support both Senator Conan's and Senator Nelson's bills. It'd be so nice to put this issue behind us and finally achieve federal conformity. So if a taxpayer didn't have federal liability, wouldn't have state liability, they wouldn't have federal. And it would just be a nice moment of clarity to achieve this. It's been a long time coming. We did the carve out on farm and small business, and you've tried to help on that, Mr. Chairman, and other members have too. But this would take care of that. There are some problems with that law. There are some complications with that law. And if we could achieve one of these two bills, we would strike that law, as you know, because we wouldn't have the entanglements with inability to put a corporate or business checking account into the mix, problems people are having with tenant farming, problems people are having trying to rent out their farm, and all that would go away, and we'd have a much simpler situation. So even though that was significant progress, this far supersedes it. And I guess I'm going to get up here again in a few minutes, Mr. Chairman, but your ideas on portability are really needed also. But we just strongly support finally achieving full federal conformity on the exemption and joining all the other states who have done that. And it'd be a great moment for family-held businesses and farms.
Thank you, Mr. Hickey. Questions, members? Mr. Nelson.
Good morning, Mr. Chair and members. My name is Peter Nelson. I'm excuse me, the Director of Public Policy for Center of the American Experiment. And I want to thank you for bringing these bills forward today. As an organization, we've been very concerned over the past few years that our tax policy is leading people to avoid moving to this state and driving people out of this state. And so I want to just touch on some of the things that I've uncovered over the years in investigating this issue of whether people are actually coming and going, and either not coming into the state or leaving the state. I really dug into this issue quite a bit. And when it comes to the estate tax, this is a real difficult issue to look at because there really is no data on wealth migration out there to track whether people are moving into or out of a state. Really the only data on wealth that we have comes from the Federal Reserve's Consumer Finance Survey. And otherwise, the IRS does track some wealth data periodically, but it's not a consistent tracking, so that's hard to look at. So we're always kind of stuck with looking at proxies like income taxes and whether people with higher income, or higher incomes, not income taxes, but incomes, whether people with higher incomes are leaving the state. And even then, the data is very sparse as far as being able to track a lot of this stuff and to do those really meaningful studies that we really hope we could do. And so, saying that, I want to first express the fact that we really have to, because of that lack of data, we have to really pay close attention to the CPA that was speaking before us, the people who are on the ground looking at these issues in the state of Minnesota and hearing from the people and advising our wealthy citizens here. But I do want to point you to a study that I released last week, and I know you all received one in your box. I'm not sure if you have it here with you, but one of the things that I did a few weeks ago is I decided to look at, okay, what's the one piece of data we do have is federal estate tax collections across every state. And we can look at the estate tax collections per return. And so we can see the size of the average estate tax collection per state. And what I then did, after looking at that, I collected that and I looked at, okay, well, so let's divide up the states. Let's look at the states that have a state estate tax, and let's look at states that don't have an estate tax. So let's divide all of the collections and returns into those two separate states, and let's see whether we have more federal estate tax collections in states that don't have an estate tax. And when you look at before the federal estate death tax credit was repealed, and as that was being phased out, we see that when you look at a state with an estate tax that had that estate tax in 2012, I picked 2012, and it was essentially the same. It was essentially the same. I've got a graph here that basically shows estate tax collections in states with no estate tax versus states with an estate tax were essentially the same. Collection per return essentially the same all the way through, even as the exemption amount increased at the federal level. This is 2003. They're all the same. They're all the same. And then right about 2009, they start to break apart. And in my mind, that gives us some substantial evidence that people started making choices years ago on where they're going to live and where they're going to die. And we're seeing right now that it's actually moved apart where in states that don't have an estate tax, federal estate tax collections per return is about $544,000. Now compare that with states that do have an estate tax, it's $321,000. We're now seeing a substantial difference. That's a 70%, nearly a 70% increase. And that's a substantial change from before the state death tax credit was phased out. And I think that really shows us that people are dying with more wealth now in states that don't have an estate tax. And I want to make one final comment, which another thing I noticed when I looked at our estate tax study, our Minnesota Department of Revenue's estate tax study. One interesting thing in that study was the point that when you look at the farm deduction, it became very clear that our farms represented a substantial portion of of assets that would have been subject to the estate tax. And it was about 10%. And that's substantially higher than you would see at the federal level. And there's good reasons why Minnesota's farms should be higher relative to the federal level. Obviously, we have many more farms in this state than nationally, and we have higher incomes from those farms. We have higher farm property values. However, it doesn't justify that difference. And that suggests to me that people with wealth have moved out of Minnesota, and those with movable assets have moved, and farms that are obviously immobile have stayed here. And they now represent a larger portion of our estates for wealthy individuals in the state of Minnesota. So I think I just wanted to highlight those two data points because those are two data points that I've uncovered that I think really speak to the fact that people do in fact move to avoid this estate tax. And with that, I'll conclude. Thank you.
And Mr. Nelson, so the lines are diverging starting in 2009. And there are other explanations for that besides people moving. I mean, in 2009, there was an ongoing debate nationally about estate tax levels. Perhaps people started doing more estate planning. I mean, there's all kinds of things that could explain the divergence beside moving. You'd have to delve into that a little deeper and see what exactly happened there. And, you know, maybe we're able to accomplish some of that as we move forward this year. Mr. Nelson.
Mr. Chair, yes, there can be some other explanations. However, I think the strongest explanation is the fact that back in 2004, 2005, when people realized, okay, this is now the current state of the law, they started making choices. And, you know, when you think, just look at the common sense issue, when you look at the common sense comparison between someone who's got 2 houses, maybe even 3 houses. They might have a house in Florida, they might have a house in Colorado, and they might have a house here. It becomes very, very easy to change that domicile for that type of individual. And I think that's what we're seeing. I mean, even the House Research Memo or report on this issue speaks to how easy it is to change your domicile for someone who already has a second home or a third home. And I do believe that people started taking that opportunity once the state death tax credit left.
And then we'll look and see what impact that has on our economy. I mean, you know, Minnesota's economy is quite strong, so, you know, see what the impacts are.
Absolutely, Mr. Chair. And that's one of the other big problems with the estate tax. I truly believe that the state estate tax diminishes all of our other revenue sources. There's all sorts of different ways that it can diminish revenue, even in addition to people leaving the state and taking their incomes to another state, reducing their consumption in this state. There's other ways that tax avoidance can reduce income tax revenues. For instance, setting up a family business partnership can transfers income or transfers those assets to someone at a lower income level usually, in general. And so that sort of reduces our income level. Just gifting assets usually gifts those assets to someone at a lower income level. And that then is subject to a lower income tax rate. So all of these different tax avoidance strategies to avoid the estate tax generally lead to lower income tax revenues and can often lead to, if you're moving, lower sales tax revenues and lower property tax revenues.
Sure. Senator Nelson. No?
I didn't have a question.
Senator Thompson.
Thank you, Mr. Chair. You know, something I find fascinating is a large part of the discussion in this committee when it came to the tobacco tax was that if we tax something higher, we'll get less of it. And people thought that, you know, taxing cigarettes, taxing tobacco at a higher level is a good way to discourage smoking. Yet when we start talking about taxing estates or taxing income or these things, there's a strong desire by a lot of people to say the elasticity is 0, that people will not react to those taxes. And that just doesn't stand to reason. As Senator Gazelka correctly pointed out, it takes some time. After all these income tax increases that we put into the state didn't go into effect on, back in 2009, it was a couple years ago that was passed. And it takes some time, but I think we have to be fair. Okay, I'm one who opposed the increase in the tobacco tax, but I am intellectually honest enough to admit that if you tax tobacco at a higher level, it'll discourage smoking. Well, I think those who believe in higher income taxes, higher estate taxes, I ask for the intellectual honesty to admit, yep, we will drive some people out of the state. We don't know what the elasticity is. We don't know how strong the effect will be, but to say the effect will be 0 is disingenuous. That which we tax, we get less of. That which we subsidize, we get more of. And much of the discussion in this committee on other topics is how can we use the tax code to influence people's behavior. So to say that it's not going to influence people's behavior or likely wouldn't in this area makes no sense, especially with people who generally have the means to leave if they want.
Very good. Senator Dietzick. Senator Rest.
Mr. Chairman and members, I would still rather be in charge and have control over the weather.
Anything else, members?
Oh, Mr. Chair.
Senator Nelson.
I see you're going to new testifiers. I'll wait till the end of the testifiers.
Thank you very much. Thank you, gentlemen. Ms. Madden, Ms. Connery, and then Ms. Schubach.
Chalbach.
Got the names are wrong on this list also. Well, come on up, folks, and introduce yourself for the tape.
Thank you, Mr. Chair and members of the committee. My name is Nan Madden. I'm director of the Minnesota Budget Project. Appreciate the opportunity to talk about some concerns we have about these bills and others that would make significant cuts to the estate tax this year. And while the two bills before you right now, I think, raise our largest concerns, my comments also apply to some degree to the previous bill and other bills that would make large cuts to the estate tax. Three primary concerns that we have are, first, these bills would reverse some of the progress we've been making towards a more even distribution of taxes in Minnesota. Secondly, it creates an unlevel playing field among Minnesota taxpayers. And then third, the cost of this bill also presents some concern about crowding out other priorities. So the first concern is that further large cuts to the estate tax will reverse some of our recent progress in making our tax system less regressive. The tax bills that were passed in 2013 and 2014, taken together, have made the distribution of state and local taxes in Minnesota more even across income levels. The share of income that the highest income Minnesotans pay in state and local taxes has gotten closer to what low and middle income Minnesotans pay, but it is still the case that the highest income Minnesotans pay a smaller share of their incomes on Minnesota taxes. These bills would cut taxes for a small number of the largest estates and benefit primarily high-income individuals, and that would reopen the gap between high-income Minnesotans and everyone else in terms of how much of their incomes they pay in state and local taxes. And we think that's not the right direction for the state. Second concern is that the estate tax plays an important role in providing a level playing field among taxpayers, and that's because the estate tax serves as a kind of a backstop to the income tax and applies to the increased value of assets such as stocks, but other kinds of assets that have appreciated, and that appreciation would otherwise not be taxed. The more we erode the estate tax, the more that capital gains can go untaxed. So for example, if I get a $10,000 raise, I will pay income tax on that increased income. If I buy a stock and it appreciates in value by $10,000 and I sell that stock, I will pay taxes on that income. But if I can hold on to that stock, I don't need that money to meet my expenses and I can pass it along in my estate, that $10,000 of capital gains may never be taxed. And so that creates a tax preference that's not available to Minnesotans with incomes only from wages or only from capital gains they realize during their lifetime. This issue of capital gains is a substantial function of the estate tax, and research on estates nationally finds that unrealized capital gains make up a large portion of the assets in estates. Unrealized capital gains make up about 1/3 of estates worth between 5 and 10 million, and are 55% of the value of estates worth more than 100 million. The third concern is the cost of these bills, which is $157 million for 16-17 and $178 million in the next biennium. These cuts come on top of the cuts to the estate tax passed last year. And while it's certainly true that the state is in a stronger financial situation this year after more than a decade of frequent deficits, I question whether large cuts in the estate tax for a small number of estates should take priority over other choices that would have a greater impact on Minnesotans across the state, such as sustainably funding services for people with disabilities and the elderly, making child care and higher education more affordable, or passing a more broadly based tax cut in this committee. I think just to speak a minute to the issue of where the exemption level is landing, that seems to be the major focus of the testimony so far. And so I would suggest if that is the primary issue, that you look at other changes within the estate tax so that we're not having such a large financial impact and providing such large cuts for the larger estates that would still be subject to the tax. Finally, I also want to just touch on the issue about migration, tax migration. There is a body of research nationally looking at these issues that excuse me, that finds that the impact of estate tax policies on where people choose to live is relatively modest. I certainly would not argue that it is zero, but if you look at the research, I don't think it suggests that it's a big enough factor that it should be the primary concern driving our tax policy. And certainly the research suggests that the revenue gained by keeping a small number of households from moving is smaller than the amount of revenue lost from eliminating or substantially cutting the estate tax. So I don't think these kinds of cuts pay for themselves. I also wonder if maybe some of the results that Mr. Nelson, excuse me, alluded to in the difference between federal returns, federal estate tax returns from states with and without estate tax might be explained in part by the federal deductibility of state estate tax. That might be something to look into with more detail. So thank you for the opportunity to express these concerns.
Thank you, Ms. Madden. Questions, members?
Mr. Chair?
Senator Nelson.
Thank you, Mr. Chair. Ms. Madden, do you have I recall some studies regarding the tax migration, and you might, if you have those available, at one point it showed if there were one family who moved to another state because of, well, for whatever reasons, we're assuming maybe tax reasons, but there could be others, in the upper tax bracket, how many average taxpayers would it take to replace the amount of income, the revenue to the state that would leave with that one taxpayer in the upper bracket? Do you recall the study that I'm talking about? I might have to go back and dig that up. But it showed that there needed to be so many other taxpayers to mate the same amount of state revenue as the one taxpayer who left at the upper income. Do you recall that study?
Mr. Chair, Senator Nelson, I'm not familiar with that particular study. The studies I've seen do indicate that it is lower and middle income families that are more likely to move overall than high income. Those folks tend to move where job opportunities are available and sometimes are a little more mobile. But I can also share with you, I don't have it with me, but I can share with you the research I've seen that suggests that the revenue you lose by doing substantial estate tax cuts is not made up for by the amount of taxes those families would pay if you retain them.
Mr. Chair?
Well, let's get through the testimony,
Sure.
Senator Nelson. Who would like to go first? Next, Mr. Smith?
Chairman Scoy, members of the committee, I'm Dane Smith, President of Growth and Justice, and we're an organization that conducts research and advocates for a broader prosperity in Minnesota, and especially for public investments in human capital and physical infrastructure that we know are conducive to long-term private sector growth. We are very encouraged to see some rather amazing, robust business growth in Minnesota recently, and also to see increasingly bipartisan and ideological consensus around the fact that there is not enough equity in that growth. Rather, there's an overwhelming evidence of growing economic and racial inequality in our state and nation, in income, but even larger disparities in accumulated wealth. There's pretty broad agreement now that growth and wealth is not being shared in anywhere nearly an equitable fashion, as equitable as it used to be at least. And this is reinforced by news recently that the top 1% globally would soon have more than half of the world's wealth. Excuse me. There is a continuing evidence from Minnesota business press that middle-income wage earners are still seeing little gain despite soaring profits and job growth. And our own research in Growth and Justice in 2013 showed that Minnesota inequality is worsening over time at a faster rate than other states, although we're still not quite as unequal as other states and the nation as a whole. The report showed a steep decline during the recession in median income, an increase in the poverty rate, overall inequality, as measured by the classic formula known as the Gini coefficient. In this context, we really urge that you keep estate tax reductions, if you do them at all, to a minimum. We think a policy of doing no further harm to our inequality situation is a good principle in both tax policy and on the appropriation side. Taxes are not the only and probably not even the most important factor in growing state and economic and global inequality. There's family structure, there's capital chasing cheap labor overseas, trade policy, outsourcing, immigration, the technology revolution and automation. All of these may play a more important part. But tax policy certainly is a factor in inequality, and declining effective rates at the top for income, capital, and wealth over the last 30 years have to be considered as contributors to this inequality. Large reductions in the estate tax, unless they are replaced from other sources that are progressive in incidence, will almost certainly exacerbate inequality and erase the gains against regressivity documented in our latest tax incidence study. We don't oppose any and all tax cuts. We support increases in credits and deductions for child care, the renter's credit, for early childhood education, various other forms of relief for middle and low-income families, especially if they can somehow be targeted to education and training and improving capital, which is Minnesota's formula for economic growth. We don't want to become a cold Florida. We could actually further move the needle on inequality if some or much of the proposed cuts in estate taxes were extended instead to these hundreds of thousands of folks who are actually working hard but struggling to make ends meet and to build equity and wealth for themselves in our state. We know there's strong bipartisan support for that kind of relief for working households who are unlikely to ever have multi-million-dollar estates to leave to their heirs, but who stand a better chance of doing so if we give them and their children and their heirs a little bit more equity now. Thank you, Mr. Chair and members of the committee. Happy to answer any questions.
Thank you, Mr. Smith. I think we'll finish up with the testimony and then have questions. Mr. Conry?
Yeah.
Conry?
Chairman Skoy, members of the committee, my name is Chris Conry. I'm here today for Take Action Minnesota. We're a statewide grassroots advocacy organization with over 15,000 members and supporters in every Senate district in the state. I'm here today to raise our concerns about Senate File 743 and the range of estate tax cuts being proposed today. Thanks to the work of this committee over the last few years, the state's tax code has become more fair and our state's tax revenue has become more adequate. We applaud you for this work and believe that it's set our state in a positive direction. The proposals before you today would reverse this direction by significantly weakening one of the only two progressive taxes the state administers. In fact, last year's estate tax cuts had a negative impact on our tax system, moving the suits index measurably in the wrong direction. The 2015 tax incidence study identified last year's estate tax cuts as one of the two recent tax policy changes with the most regressive impact on our tax code overall. If tax cuts are a priority for the committee this year, we'd urge you to think of lower and middle income families in Minnesota. There are progressive tax cut options in the form of expansions of the renter's credit, the working family credit, and the child and dependent care credit, and we hope you'll keep these options and these families in mind as you make your decisions. Thank you for your time today.
Thank you, Mr. Conry. Ms. Schubach.
Thank you, Mr. Chair. My name is Jennifer Schabach. I am the Legislative Director for the Minnesota AFL-CIO. We are a labor organization with over 1,000 affiliated unions with representing over 300,000 working men and women throughout the state. Thank you for allowing me to, as everybody here has already said, so eloquently express our concerns for the estate tax bills that are before you today. I will try to avoid duplicating anything that was already said regarding the estimates for the fiscal impact just for the bills that were passed last year on the estate tax, reducing the collections by in fiscal year 17 by almost 30%. And this bill making an additional $157 million in cuts in the upcoming biennium. We talk a lot about the budget surplus as if it's a kind of like a bottomless pot of money. However, when you look at the other serious needs we have facing our state, our infrastructure, education, long-term care, et cetera, and other cuts or tax credits that were mentioned here to help struggling, working, middle-class families. With these not showing up on the spending side of our budget, they can be very deceiving, I think, and don't think that that's an appropriate way to balance our budget or move things forward on our budget. Again, we encourage you to do the least amount of harm. I sent it to Senator Rest's request kind of at the beginning of the hearing regarding kind of policy, the best policy or the, best working policy. I actually conferred with Jeff Van Wyken in the back there, because that's not I haven't dug through the policy, but ironically, I don't know if she asked that because it was two of your bills, actually, Senator Rest, Senate File 837, in which the cost is all up front and there are no tails. We see that as a good policy and not, things increasing as it goes out. And Senate File 881 is another good one. If it makes more sense or a more sensible way to apportion the tax, we would be amenable to that. Thank you for your time. And
thank you, Ms. Schabach, and we will take into account the one-time nature of some of the monies that is counted as the budget surplus, because it is not all ongoing and not all eligible for some kind of ongoing spending or tax relief. Very good point. Questions, members? Seeing none, thank you all very much. And
Mr. Chair?
Senator Nelson,
I just wanted to draw the committee's attention to two letters that I think were in your packet or handed out today, and that is from the Farm Bureau and from Minnesota Farmers Union in support of Senate File 743 and Senate File 198. Thank you.
Thank you, Senator Nelson. Anyone else wish to testify on Senate File 743 and 198? Seeing none, anything else, members?
Chair?
Senator Senjum.
Chair, thank you. Excellent hearing, by the way, this morning. Thank you. I'm sitting here thinking about this thing called regressivity and the testimony. And as I recall Miss Allen talking about her operation, what to me is really regressivity is if she and her brother were to fold their operation up today, tomorrow 43 people would be out of a job, and that's regressivity, and that's real, and I don't think we can forget that side of this discussion either.
Anything else, members? Seeing none, Chair will lay Senate File 743 over for possible inclusion. Chair will lay Senate File 198 over for possible inclusion.